Good afternoon, everyone. I'm Dan Hussey with Zaner Ag Hedge, bringing you today's Strategy of the Day update for Monday, August 16th, 2021. Want to begin, I think, probably with just quick weather updates here. It's not much to speak of, so we'll get through these quickly. Maximum temperature forecast over the next 6 to 10 days is looking pretty mild, barely pushing above the 90s, anywhere above Iowa and or Nebraska through Missouri there. And honestly, it looks like pretty favorable weather conditions going into the remainder of this pod filling season for soybeans. Probably a big reason why we haven't seen much follow through on those charts to the upside. Both the 6 to 10 and 8 to 14 day forecast looking pretty favorable. Throw the weather to the side here for a moment, though, and I think the big news event that we're all waiting to see at the end of this week is the Pro Farmer Crop Tour numbers. USDA obviously acknowledged some yield cuts there for corn, surprised the market last week. We had an almost limit up move at one point, but the market did fade back into to retest back above that range we've been in. We'll look at that in a moment too. But let's finish up here with a quick look at weather. Nothing to speak of in terms of storefronts moving through much of the western Corn Belt. That eastern Corn Belt and through the Ohio River Valley's got some rain here. Might get even more rain with this hurricane that's pushing up through Florida. Excuse me. And there is a little bit of a tropical depression here that's forming over and going over the Dominican Republic and Haiti here, where we're probably going to see maybe even another hurricane form. I was tracking something out here over the Atlantic. It's not on this chart, but the full swing of hurricane season is underway. So expecting to see those storms push into the Gulf over the next week or two. Above average forecast here in the 6 to 10 day forecast for most of the Midwest. Really not a super dry forecast, but weather's weather. It's a moving target, and it's subject to change at any minute. The 8 to 14 day forecast still showing above average precipitation for pretty much everywhere but the Dakotas and down through Nebraska, but Oklahoma through Missouri up through Iowa, Illinois, Wisconsin, Minnesota, and into the parts of the Ohio River Valley do look like they've got chances of rain. More importantly, though, we got some decent heat units. We're not really dropping off in temperature. Certainly at night we're getting a little cooler, but during the day still getting plenty of sunshine through the 6 to 10 and 8 to 14 day forecast. Since last week, and certainly last Friday, since we took a look at some of this, you can see how pretty much everywhere, with the unfortunate reality of some places that could have used rain, it's a little too late for much of that corn crop, but getting rain up through North and South Dakota would have really, really helped, help fill out some pods that, might not get it now. So those pro farmer numbers will come back this week with pod counts, and we'll be able to better hone in, I think, on that yield. But generally speaking, for everywhere else, weather's been looking good. And as a shout out to our senior market strategist, our VP and chief market strategist here at Zaner Ag Hedge, our very own Ted Seifried is out in the field on that western belt. He's making his way through South Dakota. I'm pretty sure he heads up through North Dakota through the rest of his stretch. So he'll be on the ground providing us with real-time updates of some of the, or maybe he started up there and he's heading down to Nebraska. Nevertheless, he's all over through that western Corn Belt and providing us with real on-the-ground reports there. Follow him at the Ted Spread. I've got his Twitter pulled up here so you can go check him out for yourself. He's helping us bring in some of the real numbers on this Pro Farmer Crop Tour and is one of the analysts in the fields collecting that data. So let's hop into the charts here. And remember, trading futures involves risk and is not suitable for all investors. And everything I talk about here today is just my own opinion, not a direct trade recommendation. But I would love the opportunity to talk about your marketing, talk about the trade plan, and talk about what we here over at Zaner Ag Hedge and can do for you in general for part of that plan. Starting with the U.S. dollar index here today, we've seen a little bit of weakness in the last 2 days of trade. Some back in trade price action retracing into the range between 91 and 93 we've been in. Came back for a nice test of this 18-day moving average, but still remains solidly above the 5,500 and 200-day moving averages, which all, by the way, have given us a golden cross here in the short term with upside, that, in my opinion, should take us back towards a test of the 94 to 96 area, some old broken support now is resistance, but otherwise somewhat of a range here since the start of the year. Pushing above the highs here at 93.50. We've talked about how that could be some dollar strength, and that might weigh on our export markets, but that's done nothing here over the last 2 weeks now to inhibit Chinese exports. Today to unknown destinations, another cargo full of 132,000 metric tons of soybeans were sold in a flash sale and overnight exports. We're going to start to see on this week's Thursday report some really big weekly numbers to confirm all of those flash sales and to make sure they're making it onto the books. Now, that doesn't mean, though, that these sales can't get canceled. I hate the C word this time of year, but we have to consider that that is a political play. China can always pull out of the bag at any time. However, they are willing to commit, at least financially at this point, to taking those cargoes of beans. And I think it's really hard to make an argument that China doesn't need the purchasing they're doing. So cancellations would ultimately, in my opinion, always be re-upped and repurchased later. So anything that we would see might just be short-lived. Although I am not anticipating cancellations on this report. I think so far we're starting to see demand prove itself, and that's a good reason why we've been holding on to some of the strength on the charts for soybeans at this time. So we're going to take a look here to start us off with November beans here on the daily chart. We'll get into the shorter time frame obviously here in a minute, but wanted to point out that since we looked at this chart last, and we're discussing this chart last week, the market had really been staying below that 100-day or this blue line, the 100-day moving average, until our report where the WASDE report sent us above it. We've now stuck above it, and now we're above that 50-day moving average. The only issue is there is that trend line against the highs that's been forming kind of that wedge structure that continues to hold, and I'll break that down on the smaller time frame in a moment. The 200-day moving average down around 1235 now continues to rise and will be overtaking this prior low here pretty soon at 1240. So that's a good indication that this chart has some strength under it, and we certainly aren't willing to, at least from a technical level, break down just yet. And seeing export demand continue to come in for soybeans is very supportive at this time. We're above all of our moving average. The 18-day coming in at around 1348. The 55-day at here at 1359, and the 100-day at 1344, all crossing, potentially giving a bullish crossover here if we can, continue higher in price crossing over these levels. We still haven't, going all the way back to July of last year, a year ago, when the 55 moved above the 100 moved above the 200. We've been in this golden cross or bullish situation. So seeing some consolidation above these levels isn't out of the question. And I definitely think that if we were above $14, we'd be seeing considerably more demand destruction on the board. But relatively speaking, it seems like our export partners are pretty happy buying and exporting those soybeans, even though they're in the teens. So let's get into the smaller time frame chart. We'll work our way down from a 4-hour chart here on the November soybeans. The 50% retracement from our swing highs here around 1420 down to our recent lows just before the report there for the month of August around 1308. That came in, and we actually traded that news spike that day up into that 1362 area. Following through now, those highs is certainly a bullish development. My only concern is this trend line against the highs, and our secondary resistance we talked about last week around 1378. Which, sure enough, happened to be the high here for the month of August now. We've pushed up into, and fading off that level today wasn't a great look. We still closed up 3 cents on the day and are trying to trade above that new spike high all day. That's certainly bullish. However, this is a very choppy development in this move higher, so we're going to really want to see this market push up to a test of $14. Prior highs potentially around 1420, and maybe even fill that gap up around 1340 to really, 1440 to really feel more comfortable with a true bull run now, which absolutely can happen. The balance sheets are tight. We saw the balance sheets kind of get a push from the USDA here, sticking around the 155 bushel, or excuse me, million bushel carryout number. So the USDA unwilling to really commit to any major changes on the soybean side, even though they did walk back on that demand a little bit. The slight cut in production we saw out of WASDE last week offset that demand. And depending on how that pro-farmer crop tour comes back, we might be able to dial in on how exactly this number, our yield numbers are actually coming out this week. So because we all know the USDA number we saw last week is just the best guess of their estimates. And in my opinion, is just a barometer or a benchmark we set for the year. With that being said, equal legs up and 3 legs from our new spike. If we measure that first move down to the lows, 1383 would be the top end of that resistance area. Again, that to me began around this trendline resistance around 1375. So far, holding that area is, again, not super great, but pushing above certainly would be a good signal to the upside. Now, while we remain, though, in the range that we've been in for, you could use the range for the month of July as a good indication of how big that range is. 1420 highs all the way down to 1301. That $1.20 range, to me, suggests, well, so far we are still in that range until we're not. So very choppy price action is still to be expected. Some kind of catalyst will occur, in my opinion, to take us out of this range one way or the other. And I am, as an analyst, still fearful that if we haven't seen that big rally yet, we may need to kind of clear out the pipes, if you will, flush the market to the downside, find a true area where real demand comes in, both domestically and internationally from our export markets, before continuing substantially higher into the new year, kind of like we saw this time last year, which is, I mean, I guess a good reason to maybe bring up that soybean chart one more time on the daily time frame to go back to kind of show you what I mean. Last year, this time, April, June, July, August 2019, into May and July, August timeframe, we had that, maybe a little bit of an earlier sell-off here in the November bean, and never know which one of these was better, but I believe our continuation chart would show a little bit more of what I'm talking about. But this time frame here going into August, where we had a little bit of a pullback, we were certainly trading at different price levels, but nevertheless, back then, we still had some downside pressure all the way through about mid-August before we caught that rally and ran higher. So again, this could be the start of that next leg higher. We're pressing against the levels that might begin it here on the 4-hour chart. But my concern, again, is that we're still holding levels, and the follow-through here today was a bit lacking. So all of that being said, on the very short-term time frame here, our 15-minute charts, we're going to want to see this supportive area around 1360 to 1355 continue to hold. But fading down back below 1360 just brings us back to the old range we were in. And there isn't much in the way that this chart has proven to us of support until you get back down to 1330 to 1325 at this time. And that's just the cluster of old lows, and of course, pre-news and just after news spike lows that we had in that area, and the number of times that we went up and down inside of that range is a little concerning, right? The market told us here with these moves up and down that there's nothing to believe in between those levels. We are above our pre-news highs, though, and again, that 1360 to 1355 area in the near term is going to be very important for this market to hold on to and continue now this higher highs and higher lows pattern that we're starting to begin. That fades off. We're still in the same range we've been in. All right, so let's take a look now at our December corn. Certainly a bullish development since last week's WASDE report. We don't have to get too far into what that report said. Cutting from 179.5 bushels per acre down to 174.6 was a substantial cut. 3 bushels per acre below the trade, 5 bushels per acre below their previous estimates, and actually put the corn yield right in line with where I would have guessed it was in the 174 to 176 area, in terms of where I would put my balance sheet, not where I thought the USDA was going to be at that time. So them confirming that much of a cut, maybe we've got more, lower to come. I think that we could all agree that going into that report, the June estimates were certainly the highest yield estimates we saw out of the USDA all year. And and the August or the July was a push, and the August estimates confirmed that with the cut. Corn still in a range, and failure to break above $6 at this point after 3 days after that report doesn't feel very good. I'm not denying that we are probably way lower in terms of production than what the USDA is already telling us. But the big question is that, hey, above 550 in corn, are we continuing to destroy demand here? Obviously, with where the price of gasoline is, ethanol is still a pretty viable solution. But we're also seeing some political arm wrestling going on with those EPA mandates for ethanol blending. So wish that we would have gotten a little bit more of a defined policy out of the current administration that would be, a little bit more of a proponent of ethanol and a kind of green solution. It's, of course, a short-term solution because ideally a green agenda is going to move us away from biofuels altogether as well. But in terms of the long-term 30 years down the road, right? But in the short term, biofuels, to me, represent a great sustainable solution to take us off of foreign oil and other caveats. So now that we have even more turbulence going on in Middle East and Central Asia, or in Western Asia now, with pulling out of Afghanistan, oil markets are definitely going to start to chime in my opinion, to some of these political developments. And a lack of U.S. troops in Afghanistan, we really don't know now how much oil, particularly from nations like Iran, can start making it onto the market if nations like China are willing to establish a partnership with the Taliban and the new organizations taking over Afghanistan, being the middleman between Iranian oil and Chinese consumers. Afghanistan ends up becoming a very interesting playground for oil. Maybe not necessarily of oil coming out of Afghanistan, but if China walks back on their WTI purchasing from the United States because they have new oil partnerships, it's definitely something to consider, right? The price of oil today, let's actually not to just totally jump ship on corn, but I think it's worth noting that oil markets are certainly responding in however way you want to look at this. From a technical development, we just shot right back down to the low end of the range on WTI crude today, traded down almost $3 at one point at 65.73 lows. We did manage to recover almost $2 off that low back to 67.50, but we are unable to trade back into yesterday's low. Certainly, this daily candle looks a lot like a low is trying to form here around the 65 handle, but we've also been unable to see the price of crude sustain above 75. And a lot of that has to do with Russian production and OPEC production being higher. And that's not going to help with oil prices. And that could also, those drops in oil prices, for example, RBOB also kind of taken a hit here over the last day. Gasoline prices being lower doesn't help make the case for domestic demand for ethanol. And of course, then that translates into domestic demand for corn. However, the rate at which we've been killing in our slaughter and the rally in ducks beef price cutouts certainly now watching both hogs and cattle here, both those charts which are up here in the top right and just below it here, October lean hogs, seeing those prices start to rise is certainly helpful in my opinion to get more cattle on feed, get more pigs on feed as well, and that's going to help with that domestic meal and corn demand, and particularly the some of those distiller grain demand domestically. So replenishing after the slaughter is a big factor here that will keep, in my opinion, a bid under our live cattle markets, and that should translate to better domestic demand for corn as well. But we'll see, that export demand can take a hit if the dollar continues to rise. So back to our corn chart. Getting a lot of information today on other stuff, trying to widen our depth of what we're considering and looking at in some of these markets and not just talking about the charts. From a technical perspective, this kind of three waves up, this first leg that began at beginning of July, ended into the end of July. Then we had a little bit of a setback, sideways consolidation through halfway through August and one new spike rally. To me, now that we've made lower lows and lower highs here for the first day running after that news spike, suggests that we might be falling back into the range that we are caught in for the whole month of August. Not a great, it's not confirmed today because where we held lows, and we'll take a look at the small time frame charts, still suggests that we're channeling higher. We could still be, find support, but these markets need to start getting their act together and really pushing higher to set that trend in. Otherwise, we are just fading away from levels that we've seen before. How many tests of $6 does December corn need this year to fail at before it either breaks through that ceiling or proves the ceiling exists? So far, our WASDE report, as bullish as it was, has only been a test and failure to break above $6 in my mind, which puts us right into the same range we've been in. I love that December corn is above its 18-day or 19-day moving average, 55-day, 100-day, and 200-day moving averages. But if we, again, fail to break out of that $6 threshold, this market is getting exhausted and will find price, enter a period of price discovery lower. No matter what we feel fundamentally is happening out there, technicals will take over. Markets will start to reverse on a technical nature, and it won't matter what the fundamentals say until we get to price levels that are fundamentally of value to those that are commercials and entities that are willing to put a floor in the market. So far, we've seen that floor come up to the 540 area, which has been great, but generally speaking, the market still had to test $5 on almost 3 occasions here during that same period since May through now, since we entered into these weather markets and a tightening carryout type of situation. So with that being said, mind the 55-day moving average, which we are still above at 560. I think that level is of very, very big importance now that we were below the 55-day moving average for all the month of August, channeling in a range that was also above the 100-day moving average, which has risen up to 550. We're not that far away for the market to come back down and test these levels or even break below. And it's my opinion that below that 100-day moving average, which we have generally been above with the exception of a few minor few moments and about a day and a half period here, maybe 2-day period here in the start of July, we've been above that 100-day moving average since we got above it last, a year ago, around the same time that we had all those golden crosses, 55 above the 100-day, the 100-day above the 200-day, and we've set into this nice trend. Now that that trend has faltered and set up in a range, it's up to this market to prove to us that it wants to continue higher. Again, otherwise we still find ourselves in the same broken record spinning in the range, and every day we fail to break out is one more day that we could be seeing more pressure on these markets. The 200-day moving average still down around 492. I cannot rule out at this time that we could still go and test there. However, while above 560, I definitely can say that this market is trying to get its act together and head higher. And certainly the catalyst of that WASDE report with a very strong news event there to hold us up and to take us to these levels, it helps a lot. So there's a definite trend and certainly channel higher here that corn has found itself in. That channel support is right around 560. So, seeing another day lower to test that area, I'd be testing the old highs here, this congestion zone that we were, below for the entire month of August here, or I'm sorry, we were, below. Testing that area now as support, broken resistance as support. This is a very technical pennant or kind of flag-like structure after a new spike rally that's beginning. And while we remain above that level, we should still consider the market's ability to get back up for another test of $6. However, we fall below the 560 area, certainly below this trendline support and this channel support. We are still in the same range we've been in. And again, guys, I'll go back to the old videos warning of a bigger, steeper move that could take us down to the 580 to 480 area, or excuse me, $5 to 480 area and close that gap at 477.5. And honestly, I would almost welcome it at this point because this is starting to become mind-numbing watching the trend continue in this range. Equal eggs up, very similar to what we looked at there on the soybeans. That could take you up to the 1380 area. Equal eggs up takes you right up to 596. So for all intents and purposes so far, this is a market that looks like it's had an Elliott wave, 3-wave type of correction higher. It has now started to fail back. It's up to this market to push back above these highs to prove to us it can become more of an impulsive or trend-like structure, because otherwise it looks like a period of price discovery higher inside of a range and a failed new spike high that is now fading away. Again, above today's high at 580 certainly brings up our yesterday's high of 580 and move towards 594, changes all that. And certainly while we're above 560, this market has every ability to continue and reset support here to begin to trend higher. And that's something we should be looking at because I'm bullish above, bearish below that 560 area now for December corn. We did break above short-term trend lines here that were drawn from the highs from the month of August through the highs of July. But that trend line, we broke above it on the news. We settled back below it. We tried to break above it there on Friday. We settled back below it. And today we had a test of it and held and have settled back below it. So 3 days of failing to break out of that trend line does not a trend line break make. And for all intents and purposes, seems like it is still holding even after, running stops through it. A much bigger trend line from the highs of May here through the highs of July, up around 610. That would be my next area of resistance. Would be the high end of our channel resistance at this time too. If the market headed higher, be a solid test above the $6 figure and would test that trend line resistance. So we'll see if the market's got it in it to make another leg higher to that area. And certainly a breakout above would constitute a move towards, I think, $7 at that point. If not, we stay where we are. We fade back down. We could stay in this range for an extended period of time. But certainly we go back below 560. I think there's going to be, a test down to 520 to $5. It's, at stake. And below there, there is plenty of support down below $5 we can talk about. But the first area I'm looking at is about 480 if we start to break down. So going to that shorter time frame here, again, today, unlike soybeans making a higher high and higher low post news, so ever since that news spike, we have been, in theory, making lower lows, lower highs certainly, and today made our first lower low and lower high. We settled back in Friday's range, so, and being all within the news spike range, I wouldn't lend too much credence to what we're seeing on that short time frame, higher highs and higher lows. This is very much like a pennant kind of formation after a new spike rally. But again, support needs to continue to prove itself here at 564 to 560, because if we fall back below that area, we're just back into the range that we've been trying to break out of. And this new spike that we thought of as being a great reason for the market to continue higher ends up actually becoming more of a liability than it actually is. So, well, that kind of breaks down what we're seeing here for our row crops, or certainly for, I guess we can give a quick look here into September wheat. Kind of an impressive move. Today it faltered, stayed a little bit sideways, but we are certainly holding above trend line support at this time. In the short term, look for support down around the 740 area. If we continue to fall back, that's our old resistance here. Now that would be considered now supportive that we broke out of. Again, we're making higher highs and higher lows. Today was a bit of inside day price action. Look for that consolidation at the highs, but for all intents and purposes, wheat looks like it's trying to break out of its prior highs here at 770 that we made back in the month of May. And if it's able to do so, could extend its gains on, towards that $8 figure. And above at this time, because we've got a pretty good looking channel for price action heading higher now for September wheat. And again, making new contract highs in almost a decade high here for wheat. Doesn't have me too convinced that a high is just yet in place. But we see wheat start to roll over, corn, beans follow, a rally in the dollar. All of those signs would suggest that our row crops are starting to peter out. And maybe make a little bit of a top here as we go into harvest. I do think there'll be a buying opportunity, particularly for corn and beans around the corner if that happens. But again, use these price rallies if you haven't done any sales. Get some of that done. These are great prices, the best we've seen in half a decade, and you'd behoove yourself not to do so. So with all that being said, thanks for joining me here today. I hope you guys have liked what I've had to say. Definitely check out everything we have to offer over here at Zaner Ag Hedge. I can be reached at 312-277-0110. You can find me on Twitter, find me on Facebook, shoot me an email. Sign up in the links below to receive our free Zaner Daily newsletter, where you can get our entire team's commentary on current market price action. And with that being said, everybody, I'm Dan Hussey with Zaner Ag Hedge, and I'll be back with you as price action develops. Take care, everyone.